Hey, what's happening, guys? Dan Darrow here with another Options in Play video update. So, the million or maybe the $1 trillion question, right? Are is Apple bottoming? Is it close to bottoming? And are options cheap on it now? Are they worth a shot? Um, you know, like like most of you out there, the move in Apple has been pretty stunning. Uh, Maybe not totally out of the blue, right? I mean, you have seen a lot of profit taking and pullbacks in these momentum mega cap tech names. So maybe not completely out of the blue, but the magnitude certainly a lot sharper than I expected, and probably 95 of the percent of the people out there expected too, right? And there isn't really like one reason to pinpoint and say like this has caused like the entire slide, right? A kind of like a confluence of factors. Um, you know, First off, being the overall risk environment, right? Apple was hanging around well going into earnings, which kind of gave like this almost like a false narrative that people were still kind of expecting good numbers. It was kind of like a safety place to be, right? But then the mixed quarter knocked it lower, and then that kind of broke that narrative and led to profit taking because up until that point, I mean, you had seen Netflix got hit after it reported, Amazon was down, Google was down, Microsoft had popped, but then given it back. So it was basically Apple was like the last man standing, and then once the quarter was mixed, it started to slide, right? And I mean, it was a mixed quarter, but it was also the fact that they're going to stop breaking out iPhones and giving guidance going forward, and that really threw a curveball to a lot of people because there's no visibility there. It's such like an important product, and what that's done is really opened up a lot of speculation and all of these chatter and rumor and all of like these constant reports that you see where people are cutting iPhone or iPhone demand slowing, so on and so forth, which is basically what you've seen over like the last like 2 weeks, right? You've seen like suppliers to the iPhone cutting their forecast, not maybe specifically mentioning Apple in it, but their biggest their biggest player is Apple. So when they cut their forecast, people are assuming the worst. So Apple not giving guidance now is going to open it up to like a lot of this constant chatter about iPhone sales, demand, pricing, so on and so forth, which is also kind of contributed to it. And then more recently, it looked like it was just about to start to bottom yesterday, and then it got smacked down overnight when there was chatter that there could be a 10% tariff imposed on iPhones. So it's been one thing after the next, and at this point the stock is down almost 25-ish% off its high from early October, and you're probably wondering, like me and like everybody else, like where's the bottom? Well, I drew some critical lines here, as you can see, kind of 195. 195, 194, 195 resistance, right? When it lost that, held below it, which also coincided with 200-day. That set up the next leg lower. Then the most recent gap took it below 180, which going back was a pretty important level from the start of this year. So it's now below 180, and it's kind of, I don't want to say no man's land because it's kind of in a congestion area, but there is still a gap that hasn't been filled to 169.10, which it could require it to get down there just to kind of like close that gap. It's come this far. I mean, maybe it needs to get down there and close that gap. But then once you get into like the high 60s, you can see high to mid 60s. There's been plenty of support, and it traded all the way down to 150 earlier in the year. I doubt it sees that, but I mean, once you get down, the magnitude of the move, right? The stock trading. Let me pull this up. It's trading at 20s RSI right now, which is the lowest it's been in a while. So it's getting close to a point where it's oversold. It's had a really sharp move, bad news after bad news after bad news. Finally, at one point in Apple was, actually almost green. So, I mean, that if it could have pushed green and stayed green, it would have been a really great sign that, bad news is at the point where people don't care and they want to buy. So, it's getting close. If maybe not at the bottom, probably within the next, few points. And then what you're watching, so when it finally does bounce, right, is can it get through 180? Because that would be the first level. And then once it gets through 180, then that opens up this nice little like pocket where it could get into like the high 80s pretty quick with room to the 200-day up at like the 195 area, maybe as like a secondary target. Now, the thing with options, right? So that's the actual stock. Now, the thing with options is you're probably wondering, okay, like I want to get involved with the options so that they have to be cheaper now after this huge move lower. Well, yes and no, right? And what I mean by that is that yes, obviously, the 195 call is going to be, dollar wise, debit wise, it's going to be less expensive than it was when the stock was at 190, right? But are they cheap? Well, that's what I want to say. Maybe not so much. And what I mean by that is looking at this is the December expiration options you got here, right? So looking at the options, you can see that the implied volatility right here, it's still elevated. And the reason for that is because the stock has been moving so sharply in such wide ranges that implied volatility has remained pretty high. So yes, like, the stock has dropped 20 points, so the 195 calls aren't going to be trading at the same price as they were when the stock was in the 190s. But at the same time, you're still paying elevated implied volatility for out of the money options now, and that could pose a problem. And the problem is that if the stock were to consolidate, which maybe you know maybe that's what's the most likely scenario. After such a huge move, the stock could use a little bit of a pause before maybe like a big bounce, right? Like, a week, 2 weeks of consolidation, chopping around, kind of establish some support, then get a better bounce. So what happens is if the stock consolidates, then this elevated implied volatility, you're probably going to see a collapse of that, right? Because right now the options are both sides. You can see on the puts, right? Implied volatility, right? Mid to high 30s versus historical 28. On the call side, lower 30s, but still well above that 28. And that's just because the volatility in the stock has been so high compared to what it normally is. But if the stock were to consolidate, then you would expect this to contract, right? So it's like, yes, like the options are less expensive than they were when it was at 190, but like the issue you run into is if you're buying out of the money stuff right now after such a dramatic move lower, you run the risk of getting caught up in an implied volatility crush. So that's why it's like you almost need to, if you're looking at Apple, it almost is a better strategy to go out longer dated, because longer dated, right? So you can see that it comes down a bit. I mean, like the further out you go, I mean, if you go out through February, you're gonna have to pay for an earnings report. But the further out you go, that implied volatility should moderate a bit, right? And whereas the December, you run the risk of it consolidating and seeing like an implied volatility crush, right? The further out you go, it's the implied volatility is going to be a little bit less. And let's go back to the chart, and it gives you a better shot of capturing like a big rebound, right? So if it is going to bounce, I mean, it would be nice to see it snap back quickly and run 15 or 20 points, but the more likely scenario is that it consolidates, right, and starts to maybe grind up, and then it could take a little while to get through 180, but once it does, then it could open up a bit. So it's like, yes, the short-term options are tempting, but you have to recognize that the implied volatility is elevated because of the nature of this sharp move. So the options, dollar-wise, they're obviously going to be less than when they were when the stock was up here, but they're also not cheap, and that's why I'm thinking that, like, if you do want to get involved, 10 technically there could be a little bit more downside, but it seems like, with RSI's kind of getting down into the low of what it normally does. You can see down here the RSI. It's kind of getting down to like the 20s, 25, which is where it's bounced in the past, right? You can see here. So it's oversold. It's kind of washing out. It's got some support down in the mid-high 160, so it's probably getting close to a bounce. But if you're looking for a rebound, avoiding like the near-term options might be a wiser bet, just because of that kind of like elevated implied volatility. So we all love options, or I love options. Maybe you're learning about options, and that's why implied volatility can be a kind of like a tricky component of option pricing. Especially if you're not really aware of what you're paying for, and that implied volatility kind of it works both ways. If the stock's running a lot, I mean, it could be higher, but also if it's dropping a lot, then implied volatility is going to be ticking higher too. So it's you really got to be paying attention to what you're paying for. And with a stock like Apple, which might not have like an immediate snapback, paying higher prices could kind of come back to bite you in the butt if the stock consolidates. So as always, love to hear from you guys. Questions, comments. Every once in a while I try to do a video, maybe getting into like the like the nitty gritty of options a little bit more versus just focusing on setups, just because it's always nice to like talk about option dynamics a little bit more in depth. So I hope this helps. Have a great night, and I'll talk to you guys all tomorrow.